The latest guidelines from the RBI came as a bit of a shocker. This is with regards to project financing, where the RBI essentially is saying that on all projects, lenders have essentially got to take the standard asset provisioning from the current under 0.5% to 5%, of course, in a phased manner. What are the implications of this, and how are lenders going to sort of deal with this is something which we want to discuss with Sunil Mehta, Chief Executive of Indian Banks Association, IBA. Mr. Mehta, good morning. Good to have you with us here. Thanks for your time. So you've had, I guess, 24 hours or so, a little over that, to kind of not formulate feedback, but what are you hearing from member banks on this one?
So on this issue, our formal discussions with member banks is yet to happen. That will take its own time because we discuss in our various management committee, credit committee, and there will form an industry level opinion. But I can share with you my thoughts on it. And my thoughts is, I think the bankers have learned infrastructure financing problems in a harder way. So there was a time when they were aggressively lending to the infrastructure sector. Some of the projects could not succeed because the land acquisition could not take place, or necessary clearances from government took longer than the expected time, or sometimes the pollution control clearances were not there. Sometimes the land availability was not there, NHAI could not acquire it, or the concessionaire could not provide to get it. So because of these reasons, a large number of projects, and especially some of the promoters, have taken more number of projects than their capital or balance sheet permitted them to take. So led to problems into the infrastructure sector. I think learning from that credit cycle, RBI has been gradually tightening the belt and making it stronger, because now again a stage has come where the country is aspiring for a multi-trillion economy, and where the push for project financing will be great.
Yeah.
So
I think the RBI is being cautious, and as you said, they kind of want bank balance sheets to be stronger, to be able to withstand shocks, etc. That point is taken. But if you can talk on the specifics, the 5%, for example, right? Is it on the lower side? Is it, when we've had loss given default, we've had, the rates have been higher. So on what point specifically, if banks 100% will ask for relaxation on this, but on what specific points?
So there are 2-3 things. These measures will bring in a large financial discipline, not only with the infrastructure concessionaire, but also with the banking system, because while documenting a COD, they will factor into all the factors, because the moratorium, which was earlier for a period of 1 year, now that has been reduced to 6 months max, and it is expected that the project from the COD should start earning cash flows. And there are other things which have been prescribed to can be like a reporting of it and classifying it, like if there is a delay, maybe because of the exogenous reason, or there is because of endogenous reason. So if exogenous reasons are there, then there's a different treatment. But if the endogenous reason, then the time frame is different, and there is an incentivization for even completion, because the type of provision that has been said, it is only to undertake and take care of the risk involved at the construction stage. Once this COD is achieved, I think bankers are now free to reduce it to from 5% to 2.5%. And in case of a successful cash flows, where they find that permissible repayment obligations can be serviced, it can be further reduced to 1%. So I think that is very logical. That is incentivizing timely completion, proper documentation of the COD, taking all this factor, not just on hypothecations, but one thing, and then not achieving a financial closure without getting the proper sanctions in place. So this will definitely make the project financing more prudent, because ultimately we have learned the lesson from the past, and in the process the industry will gain. And the provision is not something going out of the balance sheet. Somewhere it is providing a cushion to absorb the shocks in case that occur, maybe because of the assumptions are belied or other factors. So I think the steps which have been initiated by RBI are very prudent one, and will deliberate at the industry level. But at least in my personal view, I'm supportive of these steps, because this is a time where the infrastructure is bound to grow to meet out our aspirations of a multi-trillion economy and third largest economy.
Right. So I mean, Mr. Mehta, you're listening to you. I mean, I think the feedback would be 100% in support. That's what the IBA will send.
And that's my personal views, and maybe while we deliberate at the industry level, we'll come out with what we think about it. Even today provisioning. Today,
Okay,
all the public sector banks are valued by the market because they could make provisioning during the last preceding year. Their provision coverage ratio is 90%. Now that is factored into their market capitalizations. So somewhere this provisioning is not something which is totally hurt balance sheet. Sometimes it provides more cushion and shock absorption capacity.
Yeah, of course. But this will have to be taken through the P&L, right? This provisioning?
Yes. All provisioning comes from P&L and kept as a cushion. So that's the additional capital buffer.
Yeah. Now, would you just two things? One is it applies on all loans, so earlier loans as well, right? So there is this slight retrospective bit in this. Any thoughts specifically on that? And second, in your opinion, from a lender perspective, I'm not sure if you've had one-on-one conversation, not maybe a full meeting. Does this sort of hurt project viability from a lender perspective if you have to make another 5% provision?
Of course, the provision will have to be provided. So it will have some capital cost because it will have from the balance sheet. So it will have some costing impact. But that costing impact will definitely be set off when the credit cost will come down. And with these measures, now everything is well defined. People know if there is a DCO, how much time it can get extension, 1 year, 2 year, and the maximum 3 years. And then how to unlock this provision earlier. That was not permissible, at least for 1 year. Now, the moment this DCCO is achieved, that can be unlocked. So from 5% to 2.5% can be gone. So all these things will provide a greater incentive for a better financial performance and the discipline, both for the concessionaire as well as for the lender.
Okay. All right. We'll leave it there. Mr. Mehta, appreciate you joining in. And, once you have that full meeting, as you said, and you deliberate the matter with your member banks, we'll have you back with sort of what the meeting really threw up and what other banks are thinking about as well. But you're, of course, very much in support of what the RBI is proposing. And as you said, that is your personal view right now. We'll